This is a download from BFM 89.9, the business station.
Dodger, very good morning to you. Let's get your views on oil prices in terms of reports out of the US that at the current rate of record oil production, US oil storage facilities will be exhausted in under 2 months, sometime in mid-May, and that as a result, prices will crater even further.
Good morning, Chung. Well, it is true, and if I were involved in the markets, what I would be watching, there's a tank complex in Cushing, Oklahoma. It's one of the most important ones. We expect that to reach its capacity in the next few weeks, just as you're implying, and that will be a challenge. They are constructing new storage tanks very close to there, so those will probably hold another 3 million barrels of oil. But what this means is that U.S. stockpiles can hit record highs for the 10th straight week. So if everything was just normal, what the industry should do is to shut off their wells until growing demand catches up with the shrinking supply. But that's not going to happen. The oil market is oversupplied. The only real variable, if you hold oil flat, the only real variable is currency moves and how they're going to impact commodities demand. We're seeing shale output that's barely slowed. U.S. crude supplies stand at 80-year highs. So, yes, we expect that there's going to be increasing pressure to the downside. But also, Chung, there will be the price of oil will act much more in terms of trading and fluctuations based on demand and supply being out of balance, not in terms of the economic growth of the future of oil. So it's going to be trading much more like a commodity as opposed to what's really happening in the market. We expect that the market is going to be having much more to the downside, but now we've got some additional variables. So it's not just going to be straight down, and we're going to see some more fluctuation. There'll be opportunities for both ways.
Well, Dodge, do you see any credence in this idea that come mid-May, there'll be a lot of dumping of oil prices, basically barrels of oil, and that prices of West Texas Intermediate or WTI is going to crater, number one, and number two, what kind of levels do you think we're going to see come mid-year?
Yes, if you hold everything constant, there is a great risk of that, just in terms of supply and demand. We expect, though, there are certain other variables that really are coming in. You have the Fed monetary policy, you have interest rates, you have China and what's happening over there in terms of their refocusing internally as opposed to exporting. So there's a lot going on that could delay or change the inevitability of further downside risk in oil prices. But the trend is down. It's not going to be down completely, and it's not going to be in one direction. There will be volatility. That's much more based on commodities and trading as opposed to what's happening in terms of supply and demand. But yes, we do expect we're looking perhaps down into the 30s, but it won't be one way and it won't stay there. And it really depends on how fast the economy can start growing for real, and where the supply of oil starts to meet the demand, and then hopefully the demand will start growing, and so that there will be some sort of around $30 to $35. We would expect to have some balance, and then the possibility for growth in oil prices.
Dodge, referencing your statements on Federal Reserve policy, how did you interpret Janet Yellen's dovish comments, which is, of course, contrarian to what the market was thinking, and the timetable for a raise in rates to be pushed back by September, not June at the earliest?
Well, I think what's happening is it's no longer just a simple equation the way we've been looking at it in terms of interest rates versus fundamental growth. Now we have the price of oil, and the perceived downturn in price of oil is beginning. The perception, Chung, is that that's going to hurt the economy more than help the growth of economic progress, and that's a slightly different perception. And the fact the U.S. dollar is strong relative to other currencies, that's another part of her input, all of which is going to make her hesitant to A, start, and B, accelerate the perceived growth of interest rates. So she's reacting, Yellen and the Fed now are reacting to many more variables, not just pure economic growth and interest rates. The primary ones obviously are the price of oil and the U.S. dollar strength. And when you have four different variables, it's hard enough to trade just the currencies because you have strength on one side and strength and weakness on the other side. So it's become much more of a question mark as to what's going to be happening. And so I think that's part of the reason why the Fed is taking it very slow and very cautious, because it's hard to tell how much of this will be longer term and how much of it's just short-term trading.
Dodge, there's this idea that Yellen is afraid of raising rates, and these concerns reference the fixed income mutual funds build-up, for example, or the fact that emerging markets such as ourselves might trip up, thus hurting the U.S. recovery. Is this fear, concern realistic?
Yes, it is. It is, Chung. Not directly, but indirectly. And Yellen is very smart to understand the implications of this, not just the direct U.S. dollar versus other, not just the U.S. the price of oil and the growth of demand. She has a much more basic understanding of how all these variables are going to be working. And right now, she doesn't see much of a reason to start the increase. And so it is much better to be cautious, because once she takes that first move, once the Fed indicates that the interest rates are going to increase, yes, it could be a lot slower. But that's a big move. And the market perception has been now interest rates are going to stay the same until they're proven that they're going to go up. And right now, there's no proof that there's going to be an imminent move. And so Yellen is being cautious, because I think she'll receive less, and the Fed will receive less negative reaction to not doing anything than they would if they do something too quickly or prematurely. And right now, what Yellen is doing is waiting for the market to prove to her that it is time to move, and she just doesn't have that. I mean, look at it, Chung. Look at our economic front. Housing starts came in weaker than expected. Industrial production and the Empire State Manufacturing came in below expectations. Retail sales were weak. They reflected the third month of falling prices. U.S. non-farm payroll numbers, yes, they were good, but participation rate remained low, and the wage growth was down. So it's not clear that there's a compelling need to make the move now.
Dodge, one of the stories of 2015 so far has been the inexorable rise of the dollar. Now, what do you think is going to drive the dollar's direction in the next coming few months?
Boy, I have to admit that I'm not sure what is going to be driving it, because there's so many variables now. There are four variables, U.S. dollar being one of them, but you have to look at the other side, what the other currencies are doing relative to the U.S. dollar. So that's one. You've got the oil. You've got it's very hard to look at the U.S. dollar unless you can understand what's happening with commodities, unless you understand with interest rates. There's so much going on that the direction is not certain. And that is part of the reason, Chung, that Yellen is taking her time to make that first move. And we suspect that the markets as a whole are going to be trading much shorter term than ordinarily so, and that the variables are going to be changing, so that, and that's what we're seeing here in the U.S. market. One day it's up, one day it's down. That is the shorter term reaction to what's happening. We suspect that there will be a further smoothing out, but Chung, I do not expect this to be changing over the next 3 to 6 months.
Dodge, one more question, and it's on China. And how do you interpret the government's reiteration of the fact that it's impossible and unnecessary to maintain the very high growth of the past in terms of the implications to China-dependent economies such as emerging markets in Asia?
Well, this is important. China's economic and policy landscape are really at an important transition point. The two primary drivers in the past, the public investment and exports, they are going to be taking a back seat. And you take a look at, we're now at the beginning of a focus shift away and towards greater emphasis on domestic consumption. That really, I think, is what they were talking about in terms of higher quality, the fact that there'll be more domestic consumption. And the Chinese are trying to engineer a controlled slowdown. That's going to be very tough. And so it's going to take time to work this through, and it's not going to be in one direction. It's going to be very hard for economies that are dependent upon Chinese exports. I think you're going to see a greater significance of what's happening in India. They're not at the same level, at the same stage that China is, and they may start to replace China in terms of the export world at this point. So it's going to be very difficult for those countries that are relying on what's happening in China in terms of their exports. But the transition will occur, and given all the other uncertainties, I suspect that China will be much more of a stable factor in this transition than what we're seeing in terms of oil and some of the other factors.
Dodge, thank you for your views. That was Dodger Dolan, the Chairman and Chief Investment Officer of Lender & Fuse Capital Managers out of New York City, BFM 89.9.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.